Hey everyone, I'm Gustavo. Welcome back to the channel where we break down complex financial topics and make them easy to understand. Today, we're diving deep into the world of investing, comparing some of the most popular options available in the US market. We're talking ETFs, index funds, individual stocks, real estate, and even those seemingly safe certificates of deposit. Whether you're just starting your investing journey or nearing retirement, this video is for you. We'll analyze the pros and cons of each investment type and see who they are best suited for. Remember, building a solid financial future starts with smart investing, so let's get to it. Alright, let's start with ETFs, or exchange-traded funds. Think of them like a basket of different assets, stocks, bonds, you name it, all bundled together in one convenient package. You can buy and sell these ETFs just like regular stocks right on the stock exchange. One of the biggest advantages of ETFs is their diversification. By buying an ETF, you're instantly spreading your money across lots of different holdings. This helps reduce risk because if one investment in the ETF doesn't do well, the others can help balance out the loss. ETFs are incredibly cost-effective, with much lower expense ratios compared to actively managed mutual funds. But hey, it's not all sunshine and rainbows. You'll likely run into transaction fees every time you make a trade, and while ETFs offer diversification, they may not always offer the same explosive returns as picking winning individual stocks. So who are ETFs good for? They're a fantastic option for young investors who want to build a diversified portfolio without breaking the bank. They're also a solid choice for more experienced investors looking for a more passive approach with lower fees. Now let's switch gears and talk about index mutual funds. They're designed to track a specific market index, just like many ETFs, but they work a little differently. Instead of trading throughout the day like ETFs, index mutual funds are priced once at the end of each trading day. The beauty of index mutual funds lies in their simplicity and low costs. Because they're passively managed, they have significantly lower expense ratios compared to actively managed funds. This means more of your money stays in your pocket, working hard for you over the long term. It's all about slow and steady growth, riding the market wave over time. However, because they're designed to match the market, index mutual funds don't have the potential to outperform it. Performance-wise, index mutual funds have a proven track record of delivering solid returns over the long haul. They're a great option for young investors looking for a set-it-and-forget-it approach to investing. For retirees, index mutual funds can provide a stable, low-cost way to generate some income. However, it's essential to consider your individual needs and perhaps incorporate other strategies to meet your income requirements. Chapter 3. Individual Stocks. High Risk, High Reward. Alright, let's turn up the heat a bit and talk about individual stocks. When you invest in individual stocks, you're basically buying a small piece of a specific company. You're betting on that company's success, and if they do well, so do you. The appeal of individual stocks lies in their potential for big gains. We've all heard those stories of people turning a few $1,000s into millions by investing in the next Amazon or Apple. Investing in individual stocks requires a lot more research, time, and frankly, a higher tolerance for risk. You need to understand the company's finances, their industry, their competition, and a lot more. One of the advantages of individual stocks is the possibility of earning dividend income. Some companies share their profits with shareholders through dividends, which provides you with a steady stream of passive income. However, the downside of individual stocks is their volatility. The stock market can be a roller coaster, and individual stocks can experience large price swings. So, who are individual stocks suitable for? They're a good option for investors who have a higher tolerance for risk and are willing to put in the time and effort required to thoroughly research companies. For younger investors, dabbling in individual stocks can be a great way to learn about the market and potentially earn significant rewards. Chapter 4. Real Estate Building Wealth. Brick by brick. Let's shift gears and leave the stock market to enter the tangible world of real estate. Real estate has always been a popular investment option, and for good reason. It's a tangible asset, meaning you can see it, touch it, and even live in it if you choose. One of the biggest draws of real estate is its potential to generate passive income through rental properties. Imagine your tenants paying your mortgage while you sit back and collect rent every month. In addition to rental income, real estate also offers the possibility of appreciation. Over time, property values tend to increase, especially in desirable locations. This means your initial investment can grow significantly, generating long-term wealth. But of course, real estate is not without its drawbacks. One of the biggest hurdles is the high initial cost. Buying a property usually requires a substantial down payment, closing costs, and potentially even renovation expenses. Another consideration is the time and effort involved in managing a property. Dealing with tenants, managing repairs, and keeping up with property maintenance can be a full-time job. As for returns, real estate can be a bit unpredictable. It depends heavily on factors like location, market conditions, and interest rates. So, who is real estate suitable for? It's a great option for investors looking for a tangible asset, the potential for passive income, and long-term appreciation. For young investors, real estate can be a fantastic way to diversify their portfolios and gradually build wealth. For retirees, real estate can provide a steady stream of income through rental properties. Chapter 5: Bank Certificates of Deposit, the safety net of investments. Alright, let's wrap up with the most conservative option on our list. Bank Certificates of Deposit, or CDs. If you prioritize safety and guaranteed returns above all else, CDs might be just what you're looking for. Think of CDs as a time capsule for your money. You deposit a fixed amount of money in a bank for a predetermined period, which can range from a few months to several years. In exchange for leaving your money there, the bank agrees to pay you a fixed interest rate for the term of the CD. The beauty of CDs lies in their simplicity and predictability. You know exactly how much interest you'll earn and when you'll receive it. Furthermore, CDs are insured by the Federal Deposit Insurance Corporation, FDIC, which means your money is protected up to $250,000 per depositor per insured bank. However, this security and predictability come at a cost, literally. CDs typically offer a much lower return compared to other investment options like stocks or real estate. And if interest rates rise while your money is locked in a CD, you're stuck with the lower rate you initially agreed to. Another downside of CDs is the early withdrawal penalty. If you need to access your money before the CD term is up, you'll likely be charged a hefty fee. So, who are CDs right for? They're an ideal choice for investors who prioritize preserving their capital above all else. For retirees, CDs can play a role in a diversified retirement portfolio, providing a steady and predictable income stream. And there you have it, a summary of some of the most popular investment options available in the U.S. market. Remember, the best investment strategy for you depends on your individual financial goals, risk tolerance, and time horizon. If you found this video helpful, be sure to give it a thumbs up, subscribe to the channel for more interesting content, and hit the notification bell so you don't miss future uploads. And as always, feel free to share your thoughts and questions in the comments below. I love hearing from you. Thanks for exploring these investment opportunities with us. If you found this guide helpful, give it a like, subscribe to your channel name, and ring the bell for more. Share your thoughts in the comments below. Remember please that this video is for informational and educational purposes only, and is not intended as investment advice. For personalized financial advice, always consult with a qualified financial advisor.